All right, I know we have a whole lesson on gift tax, but this is kind of related. I mean, it's related parties, gifts, and generally you're gifting to people you know, to related parties. That's something we'll see much more in depth with gift tax, and just this is helpful as well. It's here for a reason. So for property transactions, it's important to understand the concept of basis. I mean, for everything, it's important to understand the concept of basis, which is essentially the initial value of an asset for tax purposes. When a property is transferred between relatives, the tax implications will vary depending on the selling price relative to the original owner's basis and purchase price. So kind of talking like those charts where we saw, choose the number in the middle for the basis. When property is sold higher than the relative's basis, again, kind of just a recap, we're dealing with this. We will see this with gift tax again. When the property is sold for a price higher than the relative's basis, the gain on the sale can be calculated by subtracting the relative's basis from the selling price. Now, this gain is typically subject to capital gains tax, which depends on the holding period and the seller's tax bracket. Now, how do we calculate that? Gain on sale equals selling price minus relative's basis. Nothing too shocking, nothing too groundbreaking there. Now, the property is sold between the relative's basis and the relative's lower purchase price. In this scenario, there's no gain or loss, so this is what we saw earlier. Just want to drill this in your mind, want to make sure you understand. As the selling price falls between the relative's basis and their lower purchase price, the transaction is considered a wash, and there's no capital gains tax or deductible loss that arises. Lastly here, property is sold lower than the relative's purchase price. Well, when the property is sold for a price lower than the relative's purchase price, a loss on the sale can be calculated. In order to determine the loss, subtract the selling price from the relative's lower purchase price. Now, this loss may be deductible, subject to certain limitations, and depending on the nature of the asset. If it's a personal asset or an investment property asset, a loss on the sale will be considered calculated as relative's lower purchase price minus the selling price, and there we go. Now, this is going to be important for both the buyer and the seller, understanding the tax implications. We've got some examples here. Let's just run through them because I know you love examples. I love examples. Assume a relative bought a property for $200,000 and the relative's basis in the property is $180,000. So that's the original basis. The property is then sold for $220,000, which is higher than the relative's basis. So the gain here is going to be $40,000. Now, why do we do that? Well, because we are saying that the gain on sale is the $220,000 minus the $180,000 gives us $40,000. Now, in this case, the gain on the sale is $40,000, which may be subject to capital gains tax. And we see here, the gain is fully recognized. The IRS says, yep, you're fully recognizing that. We're not taking this new basis and dealing with all of that. We'll see when we have a loss how that's limited. The next in the middle, using the same example as above, if the property is sold for $190,000, which falls between the relative's basis of $180,000 and the lower purchase price of $200,000, there's no gain or loss on the sale because we're going to use this as the basis and this as the selling price, so there's no gain or loss. Now, lastly here, again using the same information as above, if the property sold is for $170,000, that's lower than the relative's purchase price of $200,000. The loss would be calculated as $200,000 minus $170,000. And what are we choosing here as the middle? So we're going to say that the property sold for $170,000. That is going to be the lesser amount. So $200,000 minus $170,000 gives us $30,000. In this case, the loss on the sale is $30,000. And depending on the nature of the asset, if it's personal or investment property, and certain limitations, this loss may be deductible. Now, for investment properties, this loss can typically be used to offset other capital gains, or in some cases, ordinary income. Now, for personal use properties, this loss is generally not allowed to be deducted for tax purposes. All right, nice recap here. This is essentially what we saw before, and we'll see this in gift tax. The property is sold higher than the relative's basis. We're going to use the relative's basis to determine the gain on the sale. Then we've got the relative's basis. So the item in the parentheses is the new basis you're choosing. You see it's the middle number all around. If the fair market value, so we see the fair market value, donee. So we see it's the same tax rules, same tax application. If it was sold, was dealing with related parties, it's the same concept, core concept underneath. Just kind of like a prelude, this next time on the next episode. This is what we'll be dealing with when we see gift tax. It follows the same logic, and that's kind of what I really want you to memorize and understand, is that you can apply a lot of the knowledge we saw in this lesson to that gift tax lesson. Now, again, if the property is sold between the relative's basis and the relative's lower purchase price, there's no gain or loss, and then we have the relative's lower purchase price. And if it's sold, the selling price is the bottom here, we're going to use the lower purchase price to determine the loss on sale. So gift tax, a little bit different, but follows the same logic, essentially, that we dealt with related party. That's about it. Let's wrap it up with a nice summary and call it a day. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.